Hello everyone, thank you for watching this lesson. My name is Bala, and I put this series together to teach those who are interested in learning options trading the right way. If you came to this video without watching the previous lessons in this series, I strongly recommend you go back and start from the beginning. Each lesson builds on the previous one. And if you are not already subscribed, please go ahead and like and subscribe to my channel, Net New Universe, so you don't miss the upcoming lessons. In our first lesson, Introduction to Options, we discussed what options are. Simply put, a call option gives you the right, but not the obligation, to buy 100 shares of a stock at a specific price before the contract expires. Now let's break that statement down. The right. You are not forced. You have a choice. You are not obligated to buy the shares. Holds 100 shares, standard contract size. Each option contract controls 100 shares of the underlying stock. At specific price, strike price. This is the fixed price at which you can buy the stock, before expiration, deadline. Every option contract has a specific expiration date. Let's use Apple Inc., ticker symbol AAPL, as an example. Suppose AAPL is currently trading at $260. You can choose strike prices around that level. Strikes are typically available in increments such as $255, $257 and 50 cents, $260, $262 and 50 cents, $265. These strike prices are defined by the exchange based on the stock's current price. For Apple stock, given the current price is at $260, the difference in each strike is $2.50. We'll keep it simple for now. Historically, stock options expired only on Fridays. As technology evolved, exchanges introduced additional expiration days such as Monday, Wednesday, Friday. Not all stocks have all three weekly expirations. Apple does offer Monday, Wednesday, and Friday expirations. Let's say today is Monday, February 2nd, 2026. We are looking at Apple 260 strike call option, expiring Friday, February 6th, 2026. That means this option expires in exactly 5 days. Within those 5 days, Apple stock could go up or go down or stay flat. Time remaining plays a major role in pricing. Suppose Apple is at $260 and I think it may move up $5. If I'm the seller, I might price that option at $5. Full expected move. $3.50, more competitive. $6.50, very bullish expectation. If you're the buyer, you may have different expectation, and in anticipation of making profit from the trade, you may be willing to pay $2.50 or $3.50 or $4.50, or even more or less. So, when buyer and seller agree at a specific price, say $3.50, the trade happens. That $3.50 is called the premium. Since one contract represents 100 shares, $3.50 times 100 equals to $350 for total cost. Add up any commissions. Tuesday arrives. Apple rises from $260 to $263. Because there are still 4 days until expiration, demand increases. Premium may rise from $3.50 to $6. If you sell at $6, $6 minus $3.50, that times 100 equal to $250. That's your profit, excluding broker fees. You never bought shares, you traded the premium. Now let's flip it. You paid $3.50. Tuesday opens week. Apple drops to $258. Premium might drop, say, $2.25. If you exit, $3.50 minus $1.25. That times 100 equal to $225. That's your loss. Even if Apple stays near $260, the premium can still decline because time is passing. Expiration is getting closer. This is called time decay, and it is one of the Greeks, which we'll cover in future lessons. Think of it this way. Stock up fast, premium increases. Stock down, premium drops. Time passing, premium slowly erodes. Benefits of trading call options. Let's compare buying stock versus buying a call. 1. Capital required. Buying 100 shares of Apple at $260. 100 times $260 equal $26,000. Buying one call option contract at $3.50. $3.50 times 100 equal to $350. Huge difference in capital required. 2. Risk. Stock purchase risk, $26,000 exposure. Call option risk, $350 maximum loss. Your risk is defined and limited to the premium paid. 3. Leverage. With less capital required, you gain leverage. You control the same 100 shares for a fraction of the cost. That is the power of options. Drawbacks of call options. However, options are not superior in every situation. You do not own the stock. No dividends, no voting rights, limited time. You must be right before expiration. Premium can go to zero. If the stock does not move enough, your entire premium can be lost. When is it better to buy a call versus stock? Consider call options when you have less capital. You don't want to hold long-term. You want defined risk. You expect a strong upward move before expiration. If you want long-term ownership, dividends, and no expiration pressure, stock ownership may be better. Options do not move dollar for dollar with stock. If stock rises $5, the option may rise more, rise less, or barely move. It depends on time remaining, volatility, market demand, upcoming earnings. And remember, options lose value as time passes, even if price moves slightly in your favor. Understanding strike types. Using our Apple example, if stock is at $260, 260 strike. At the money, ATM. 255 strike and below are in the money, ITM. 265 strike and higher are out of the money, OTM. Deep ITM or deep OTM simply means far from the current stock price. We'll go deeper into this in the options chain lesson. So, now you know, a call option gives you the right to buy 100 shares, has a strike price, has an expiration date, has limited risk, offers leverage, suffers from time decay. Understanding this structure is foundational before placing real trades. If you found this lesson helpful, please like and subscribe to Net New Universe. In the next lesson, we will break down put options and compare both sides of the market. See you in the next video.